Now, with current estimates, revaluation, where is it? Current estimates actually vary between 10 and 50,000, depending on, and credible people, talking about between 10 and 50. More immediately, at a minimum, based on an upswell of delivery demands and tightening supply, at current prices, liquidity providers have raised their minimum estimation to 8 to 10,000 range. If you divide the 40 trillion, or close to 40 trillion of US Treasury debt, and you get $150,000 an ounce. However, the mid-band of the 10 to 50K estimates, which are coming from a range of liquidity providers and well hooked up people, the mid-range is a more realistic $30,000. And this revaluation process has begun. Physical markets, that's going to happen far, far quicker than anyone expects.
The global financial landscape is rapidly shifting as the disconnect between physical gold demand and paper contract manipulation reaches a breaking point. Institutional investors are beginning to recognize that daily paper price dumps are merely synthetic illusions, masking a massive structural shortage. Andrew Maguire, a veteran commodities insider and institutional bullion trader, asserts that an irreversible global gold revaluation is already underway outside Western control. Driven by an upswell of physical delivery squeezes and shrinking vault inventories, liquidity providers have already raised baseline price targets to the $8,000 to $10,000 range. Credible market models project central bank revaluation targets between $10,000 and $50,000, with $30,000 marked as a realistic mid-band target. If total U.S. national debt near $40 trillion were balanced against Treasury gold reserves, theoretical values could reach an extraordinary $150,000 per ounce. From an analytical standpoint, this is not speculative hype. It represents a mandatory monetary recalculation that will catch traditional paper market traders completely off guard. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Last Friday's 24th of July launch of the GC-connected Hong Kong gold clearing system is a material development. And there was very little doubt that the White House has been monitoring this state very closely. And given that China now has the infrastructure required to challenge their previously captive COMEX LBMA price setting regime, which is about to facilitate a global central bank gold revaluation process, ultimately leading to a revaluation event outside their control. And this has undoubtedly put Fort Knox back in the spotlight, which is what prompted Besant to announce that US Treasury gold reserves were, and everyone's heard the statement, present and accounted for, quote. But the real market question is actually bigger than that. It's whether the gold is there at all, and it's whether America's official gold should now be independently audited, revalued closer to market reality, and treated as a strategic reserve asset in a rapidly shifting monetary order. These things are all on the front burner. And that question is becoming much more urgent as the PBOC moves to exert greater control over global price discovery. The LBMA COMEX unallocated fudge factor, where gold swaps and leases can remain on a central bank balance sheet, it now puts the US Treasury gold directly in the line of fire. And without a full audit of the counterparty risk tied to these gold loans, the Fed will face an even larger upswell of repatriation demands and have no choice but to clear the air. And it is imminent. The questions are literally being brought forward by the fact that the pricing is being set outside of their control. And a public bar-by-bar audit would restore some credibility, but it would not answer the bigger question, is how should the 147.3 million ounces of US Treasury gold be valued? And that's a big question. And trust has already been dented. Concerns over vault integrity, that intensified in 2013. We looked at it in more detail. And this was when the Fed was unable to repatriate Deutsche Bank, Bundesbank gold in a timely manner. And it was no coincidence that the PBOC measurably stepped up selling US treasuries for gold priced in dollars at that time. And since then, foreign central banks have become increasingly wary of the US London vaulting system and the rehypothecation risks that are embedded in it, especially as the double counting loophole that allows leased gold to remain on a central bank's balance sheet. The optics really worsened when the Fed refused to even allow Deutsche Bundesbank to inspect their US stored gold assets. They were in the Treasury vaults. It would have been easy enough. And these reserves have not faced an independent third-party audit since Nixon ended the dollar gold peg in 1971. So bottom line, Fort Knox is no longer just a vault story. It's a verification, it's a valuation and trust story. And in a world of financial stress, de-dollarization, and you've got shifting monetary architecture, America's official gold reserves are moving back onto the market's radar. And the valuation issue is where this gets really interesting for markets. With no auditable data on how many competing ownership claims would be needed to be reconciled, any revaluation estimate is actually pure speculation at this point, but the floor is undoubtedly significantly higher than current prices as we see being played out today. And we're recording this on Wednesday for release tomorrow on Thursday. So, and also we have FOMC later. We'll look at that in a minute, but obviously this is a perfect gaming day for the paper markets. Now, with current estimates, revaluation, where is it? Current estimates actually vary between 10 and 50,000, depending on, and credible people, talking about between 10 and 50. More immediately, at a minimum, based on an upswell of delivery demands and tightening supply at current prices, liquidity providers have raised their minimum estimation to 8 to 10,000 range. And once revalued, and that's just the initial stage, and whether that gets done over a weekend is open to debate, possibly. But once revalued, as gold strengthens the asset side of sovereign balance sheet, it gives the Fed a powerful incentive to align with other central banks, including the PBOC, in managing a controlled upward gold price adjustment. And to provide sufficient liquidity, gold would have to be revalued significantly higher than in the 4,000 range where it is today. If you divide the 40 trillion, or close to 40 trillion of US Treasury debt, and you get $150,000 an ounce. However, the mid-band of the 10 to 50K estimates, which are coming from a range of liquidity providers and well hooked up people, the mid-range is a more realistic $30,000. And this revaluation process has begun.
Beijing's rapid expansion of physical gold clearing systems across Hong Kong, Singapore, and the Middle East marks a monumental shift in global price discovery. By anchoring international trade settlement directly to physical vaulting corridors rather than unallocated derivative contracts, non-Western nations are taking control away from paper-dominated Western exchanges. This structural migration exposes a critical market reality. Short-side paper dumps no longer suppress physical metal. Instead, they provide continuous accumulation opportunities for sovereign central banks. As physical liquidity shifts toward physical delivery networks, paper leverage is destined to buckle under the weight of unbacked claims. This creates an aggressive, long-term physical demand floor beneath the market that mainstream financial media continues to overlook, creating an asymmetric upside setup for physical bullion holders. Now, let's get back to the interview.
Now, this month of August is where the bearish paper leverage really collides with the bullish physical demand. Central banks and sovereigns have kept buying through the full 30% sell-off as speculative longs were fully flushed and then shorts were drawn in. That's given them something to take the other side of. And this is exactly the setup that the bullion banks and well-connected institutions have also been capitalizing on into weaker paper price action, taking the long side of speculators into tightening physical supplies. It's really simple. The trade setup is actually hidden in plain sight. China is opening a globally accessible physical gateway into the expanding SGE corridor through Singapore, we've got Africa, Saudi Arabia, Latin America. These are the biggest hubs. All of them are gold-centric, and they're all being prepared for integration. And at the same time, and this is going to surprise, it won't just be Hong Kong. When these others come on stream, similarly, we're going to need bullion to stock into those areas. At the same time, Beijing's already established yuan clearing coverage across every major gold trading hub. The rails are already in place. I just can't believe that it's not been seen by more people. And to understand, really, to answer some subscribers' questions, how is it the mainstream analysts are missing the point? Is that the current Western-driven bear market momentum sellers are focused on the wrong signal. They're sending the wrong signal. Price weakness is the flush, but the structural bid is the real story. And they're completely missing one of the most important asset allocation shifts since Nixon ended the dollar's convertibility into gold. Under their noses, it's happening. Beijing is turning gold into financial plumbing for a new RMB-linked settlement architecture backed by physical delivery, collateral pools, vaulting, and offshore yuan clearing. All the things required. So for traders, that means downside paper pressure is increasingly run into deeper physical demand floor, much deeper physical demand floor in liquidity. And that is a powerful setup for a substantial upside repricing. So under the mainstream media's noses, not that they know the difference between paper and physical gold, because they never differentiate the two, the structural bid for physical gold is, as I say, deepening. For price, this means China's expansion of gold delivery, clearing, vaulting, and offshore RMB settlement infrastructure is reinforcing a long-term central bank-supported physical demand gold price appreciation floor beneath an increasing liquid physical market. And by osmosis, the PBOC's clear push to reduce COMEX's influence over China's physical gold and silver markets has been the mainstream narrative, has actually seen the mainstream narrative shift a little bit. A market which has once for years been framed as weak because of rising oil prices and geopolitical risk is now being forced to acknowledge the same drivers as bullish catalysts for safe haven precious metals. And as we highlighted near the recent lows, gold's decline was being explained away as a reaction to geopolitical escalations. And that very convenient narrative masks the deeper structural issue, which is the growing disconnect between cash-settled paper pricing and the relentless underlying physical demand. Now, as physical demand continues to absorb available paper short supply, the form-fitted weakness driven by strong safe haven Asian physical demand, these inputs are increasingly being recognized as the fuel for higher gold and silver prices. And while many do not understand the mechanics behind this shift, the bullish change in market behavior is finally making people are wising up. And some of the mainstream media is actually wising up to this. Once the broader market fully recognizes this reversal, the upside risk becomes explosive. And perhaps this is code for front-running them. I'm just saying.
Central bank vault opacity and sovereign asset verification have emerged as the primary friction points in the evolving monetary architecture. Decades of unallocated gold leasing, rehypothecation, and double-counting loopholes have severely eroded trust in traditional vaulting institutions. The ongoing refusal of key central banks to allow transparent, bar-by-bar independent audits unseen since 1971 signals deep structural counterparty risks embedded in Western paper markets. From a broader macroeconomic perspective, sovereign nations are now caught in a trilemma: absorb runaway debt, risk severe currency debasement, or revalue official gold reserves to restore balance sheet solvency. When physical delivery demands inevitably overwhelm paper derivative supply, global institutions will be forced to align official metal valuations with physical market realities. This structural reset will leave paper-denominated assets exposed to severe systemic risk while locking in physical precious metals as the premier risk-free collateral asset of the next financial decade. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.